Let's bring in Ayako Yoshioka of Wealth Enhancement Group, as well as Peter Cecchini of Exonic to talk more about this. Aya, how would you feel about the way the market is postured ahead of tomorrow's number? Now, on the one hand, the market maybe was an excuse to pull back, looking for an excuse to pull back on almost anything. On the other, you know, the yields have gotten up into the zone that has become uncomfortable for stocks a couple of times in the last couple of years.
Yes. Hi, Mike. Thanks again for having me. And, you know, we've talked about this a couple of times in that, you know, the current interest rate environment, you know, yields going higher, valuations being relatively elevated, at least in the near term. And then, you know, economic data that's been relatively resilient, but, you know, expectations are for a continued slowdown, maybe at a pace that's not as bad as everybody initially thought. But that combination isn't typically the combination that pushes markets higher. So we expect at least a little bit of a pullback, especially as we head into earnings season.
You know, Peter, that's certainly very true that combination is not typically what would be a bullish formula for stocks. But there's been a lot that is atypical, isn't there, about this current cycle, or at least it's an elongated process. I know you've been kind of looking for the economy to weaken. Here we are, I think, trying to contend with data that say, OK, we might be heating up again on the economy. What's your read?
Yeah, you know, I think the June numbers were strong. That ADP print, if it's not revised, was unequivocally strong. Payrolls will obviously tell more of a story tomorrow. I do think the trend, though, has been for weaker. PMIs have been weakening. ISM has been weakening. The trend has clearly been weaker there. Initial claims, which bottomed out around 180,000, hit about 265. They were a little bit stronger this morning, meaning fewer claims. But I think the trend is a little bit weaker, and people get carried away. We have recency bias relative to the more recent prints. But at the end of the day, I think, you know, this long and variable lag that Jerome Powell even admitted is even longer and more variable than normal will eventually manifest. We had an unprecedented stimulus coming into this. And I believe that stimulus and the pent-up savings have prolonged the cycle a little bit. You know, defaults are rising, Mike, especially in weaker middle market companies. We can see all the telltale signs. And never have we not had a recession with the yield curve this inverted and with lending standards this tight, going back to 1964.
If you boil that all down, Pete, does that mean that, you know, this is a huge buying opportunity for treasuries because of the backup in yields we've seen?
Yeah, you know, we are contemplating that, right? This might be the time to receive in swaps. The instance in which it would not be, Mike, I think would be if the Fed were to, quote unquote, lose control. We don't think that that's going to be the case. But yes, over the next 6 months or so, there will be a point in time where becoming bullish of the long end will make sense if, in fact, our economic forecasts are anywhere near correct.
And on a practical level, what areas of the market would you feel comfortable with in terms of fresh money, putting it in there, given the environment doesn't necessarily, to you, look like it's a necessarily attractive combination?
Sure. So as Peter said, we like fixed income as well. But if you want to stick to the equity markets, we do see some pockets of value. You know, healthcare hasn't done as well this year as much as tech has. And we think industrials also offer some good value. And then lastly, small caps have really sort of been left for dead. And the differential between small cap valuations and large cap valuations has widened to an area that we feel that small caps could be attractive going forward. They're much more sensitive to sort of the higher interest rates, and you know, economic sensitivity is high. But we think that over the long term, they can sort of come back to some sort of outperformance relative to large caps.
Peter, you mentioned defaults have been ticking higher in some of the more stressed areas in the corporate borrowing area. And I guess, you know, you would look at the benchmarks and say credit markets have been pretty firm. The spreads have not really blown out. That's been part of the bull case. Is there an explanation for that to have, or is it, again, just a matter of, you know, time has to work its way through?
Yeah, well, look, we've been a little bit, off on the timing. This has taken, kind of 3 to 6 months longer than I thought it would. But there's always that sort of lull where spreads widen and then they stabilize. And what it really takes is a pickup in defaults to widen spreads out to their recession wides of whatever, if we talk about CDX high yield, 800 to 1,000 basis points. And that's pretty typical. I'm not saying anything that's atypical of a cycle that happens every 10 to 12 years. It's, again, a much longer cycle period this time around. So I do think that the credit markets are painting a mixed picture, because clearly spreads are not tight in high yield, but they're also not quite wide. We would expect, again, capitulation to come around 1,000 basis points or so on high yield spreads, and that would probably correspond to default rates somewhere between 8 and 10%. And that's, again, that's not atypical, and it's just taking a little bit longer because of the unprecedented stimulus that has solidified both consumer and corporate balance sheets.
If you're a little bit cautious about exactly what the markets are offering you right here, some of that view is reflected in the Fed minutes that were released yesterday. This idea that there are vulnerabilities in the economy. Do you think the Fed is either in the process of going too far with rate hikes, or already has, or do they have to keep cinching tighter while inflation remains here?
I think they have to keep inching a little bit more. Fighting inflation is their #1 goal. And when the labor market continues to stay tight, if wage inflation continues to contribute to the overall inflation picture, they're going to have to continue to raise rates.
All right. Well, they seem on course to do that at least once more. Peter, thanks very much. Good to speak with you today.